Okay, welcome everyone. I'm Alan Taylor. I'm very pleased to see you here. This is the 2025 Investcorp Lecture in International Finance and Business, and it's going to be on exorbitant privilege and exorbitant duty, presented by Hélène Rey. This event is also co-sponsored by the Institute of Global Politics here at CEPA, the Center for Political Economy at Columbia World Projects, and the Institute for Social and Economic Research and Policy. And it's also part of the International Economics and Geopolitics seminar that I run with Jeff Frieden. So, a few words of introduction about our speaker today. It's a great privilege to introduce Hélène. I had to get that in. Since 2007, she's been at London Business School, where she is the Lord Raj Bagri Professor of Economics, and she's a leading scholar in international macroeconomics and finance, known for her research on global financial cycles and external imbalances, among many other things. And she previously taught at Princeton University and at the London School of Economics. Hélène also serves as Vice President of the Center for Economic Policy Research, and previously was Program Director in International Macroeconomics and Finance, which I remember for all those great meetings you organized. And she is currently, as of 2025, serving as President of the European Economic Association. She has many honors and awards, too many to mention. I'll mention a couple. The Bernasser Prize, received in 2007 for being the best European economist under the age of 40, and the Yrjö Johansson Award, shared with Thomas Piketty in 2013. She has also devoted a lot of time to policy work and public service, which I also appreciate. She served as a member of the Haut Conseil de Stabilité Financière, the French macro-prudential authority. There will be subtitles. She also served as a member of the Commission économique de la Nation, advising the French finance minister. And switching to English, she served as a member of the International Monetary Fund's External Advisory Group, advising the managing director. And on top of that, she's a member of the Group of 30 and the Bellagio Group and many other organizations, too numerous to mention. So please join me in giving a warm welcome to Hélène Rey.
Thank you very much, Alan, for this great introduction, and thank you very much to you and to Jeffrey for this great invitation here. You stole my line. I was evidently going to say that it's an amazing privilege, close to being exorbitant, to be here today to give this lecture. So I'm obviously very happy to see all my friends here, colleagues, and to discuss an issue that has been with me and with one of my co-authors here, Pierre-Olivier Gourinchas, who is now the chief economist of the fund, for quite a few years. As you will see, we have been thinking about these issues, and it turns out that these issues are getting hotter and hotter over time. And so I think this is why I decided to give this talk today about this topic, and it will all become clear when I explain to you what it is about. Needless to say that none of what I'm saying today has anything to do with the views of the IMF, and this is joint work with Pierre-Olivier and with Michele Andreolli, who is at Boston College. So what is it that I'm going to talk about? Well, it's about the international monetary and financial system. And there, in particular, it's going to be, as you can guess, mainly about the role of the United States in the middle of the international monetary and financial system. And I will point out that there are a few very important characteristics of the role of the United States in that system. I will describe a few, I think, important facts about the way the system is actually working. And I will discuss their implications, I will document them, and I will even present a model of the international monetary system. And why do I think it's important to not only discuss facts, but to also have a model of the role of the United States? Because when we are in situations in which there are massive changes in geopolitics, we now talk a lot about geoeconomics, when there are massive changes in the structure of international relations, it's important to have a structural model to discuss them so that we can think through what these changes might mean, right? So this is why I think having some kind of structured thinking on the way things work might be important, especially these days where we see a lot of upheavals, let's put it that way, in international relations. So what are the very important facts that I'm going to document and then to model? Well, the first thing I will show you is that the United States has what has been called a world banker's balance sheet. Okay, and when I talk about the balance sheet of a country, I'm talking about the external balance sheet of a country. So what could that be? Well, this has to do with the external assets and liabilities of a country. So you have a company, obviously, has assets and liabilities. Here it's a country. So it's the external assets and liabilities which are the cross-border investment positions of a country. So what is that? For example, if you are a United States investor and you own some equity in Japan, these are the external assets of the United States, right? If you are the People's Bank of China and you own some government bonds in the US, these are the external assets of China in the US, or these are the external liabilities of the US vis-à-vis China. Okay? So this is what I'm discussing here when I'm talking about a World Banker's balance sheet. And this balance sheet comes with several very peculiar characteristics, which are very much associated with the fact that the United States is at the center of the international monetary system. And these characteristics are the following. A, the US has un privilège exorbitant. That is very hard to translate in exorbitant privilege in normal times. Okay, so it's an exorbitant privilege for the kind of day-to-day business, let's put it that way. But in crisis times, the other side of this exorbitant privilege, I will argue here with my co-authors, is an exorbitant duty, and I will explain what that means. During crisis time, this exorbitant duty also shows up, in part, as a real appreciation of dollar assets during global crisis. This is sometimes described also as a safe haven properties of dollar assets, which come up with an appreciation of the dollar in real term. And there are some properties of that kind of equilibrium in which we are in terms of international monetary system, which also show up in the properties of the real rate of interest, which is a rate of return on safe assets, which are produced a lot by the United States in the world economy. And the fact that we are going to have a model here will allow us to discuss what happens when the size of a country at the center of the monetary system, the US, kind of changes. What happens for the real rate of interest, what happens might be to the volatility of a real exchange rate, and other such characteristics. So this is what is on the menu. Of course, we could also think about using the model of what happens when the United States maybe decides to change policies, okay? And we would have to discuss exactly how this would show up in the model. But this is the spirit of this whole enterprise. Now, you won't be surprised to see that, or maybe you will be surprised to see that this paper started in 2000, or the first draft of this paper, I should say, was in 2010. It started actually earlier. But Pierre-Olivier and I have never finished it until, now. So we hope that we're going to finish the paper, but maybe it's a good sign because it does mean that the type of thing we were thinking about, right, 15 years ago, have not gone away. I think I would argue, if anything, they are even more relevant today than they were in 2010. And so this paper is about the organization of the international monetary system, and of course, from the economic side, we are building on a very distinguished tradition of researchers here who have contributed to this issue. So obviously, I cannot cite every relevant paper, but there are very important contributions done by Charlie Kindleberger in particular, there was Peter Kennan, Paul Krugman, And then quite a few other people, some of those papers, Alan has a lot of important contributions as well, Maury Obsfeld, and then a bunch of recent papers by Emmanuel Fari and Matteo Maggiore, Barry Eichengreen, etc., Ken Rogoff and co-authors. So there is a very, very rich literature, and this literature has really blossomed in the recent years. And there are more and more contributions which keep coming. Some of them, I think, are becoming intrinsically linked to the new literature which comes out very strongly right now under the name of geoeconomics. Okay? There is obviously also a very large and fascinating literature in international political economy and international relations on those topics, which are eminently complementary, and I think they find themselves very much their way intertwined in economics in the geoeconomics literature. So I'm not surveying that literature here. But there are also some very recent contributions which, interestingly enough, have built on the kind of stylized facts and ideas of this paper on exorbitant privilege and exorbitant duty, and which have been developed by some of the people who were students, for example, of Pierre-Olivier, Matteo Maggiore, or others, and which are now very much either getting published or at the stage of working papers, and that are really interesting. So I cite them, this very recent work, to the bottom here. So this is a very, very rich kind of set of issues, as you can take it in from many different perspectives. Now, we also have some newcomers in the literature, and among the newcomers we have here, in particular, Pierre Yared, who has written recently with Caroline Pflüger a paper on global hegemony and exorbitant privilege, thinking about military spending and military might and exorbitant privilege. This is actually a topic that is also in the previous international political economy literature quite a bit, right? But there they have been modeling this idea. And we had also in the recent writings, which have been fairly publicized, of Stephen Miran, who was former chair of the US Council of Economic Advisors, a US guide to restructure the global trading system. We had some of discussions of the organization of the international monetary and financial system. And it's quite interesting to see how different the views are on how the international monetary and financial system work. So here, I'm just going to give you the background of where exorbitant privilege exorbitant is coming from. So actually, it is often attributed to Charles de Gaulle. Okay, the General de Gaulle was president of France for a while, among other things. And it is the quote was often attributed to him, saying that the US had this exorbitant privilege about the role of the dollar in the international monetary system. It turns out that at the beginning of the 2000s, when I was assistant professor in Princeton, together with Pierre-Olivier Gourinchas, we were trying to find the exact quote of Charles de Gaulle to find the original text in which he would have said that, and we could not find it. It was very frustrating, so then I asked some of my colleagues there, and I asked in particular Andrew Moravsik, who was at the Woodrow Wilson School at the time, whether he knew where de Gaulle had talked about the exorbitant privilege. And Andrew did not know either. He looked at it and he couldn't find it. And then he had the brilliant idea of asking his colleague in Paris at the Sorbonne, Georges-Henri Soutou, whether Georges-Henri Soutou knew about it. And Georges-Henri came back and said, yes, but it's not de Gaulle. It's actually in a press conference of Valéry Giscard d'Estaing, which is in the annals of Le Figaro, and he showed us the text. And this is how we found out that actually it was Valéry Giscard d'Estaing who had formalized the idea of an exorbitant privilege, even though the idea was probably in the air, and most likely it was Jacques Rueff, the economic advisor of de Gaulle, and de Gaulle himself, who probably had talked privately about this, and Giscard came out in a press conference with it, but we don't know that. But in any case, the only record we found is from Valéry Giscard d'Estaing. And at the time, what the idea of De Gaulle was, or here you have the point of view of Jacques Rueff, that the country with a key currency, which is the United States, is in the deceptively euphoric position of never having to pay off its international debt. This situation is a result of a collective error of the historic proportions. That was his view on the exorbitant privilege. But De Gaulle was talking about it maybe a little bit more precisely. He was saying, actually, the fact that the United States can issue the dollar and everybody wants dollar is what explains that the US can very easily refinance and buy European companies, essentially without repaying. So because everybody wants dollar, the US can borrow very cheaply and keep on borrowing and use this money to buy European firms. And that's what made De Gaulle very upset. He was very frustrated by this idea, and that's what I think he referred to somehow as something like an exorbitant privilege. So that's the view, historic view. It was in the 1960s, and it was during the Bretton Woods system, evidently, where there was a shortage of dollar, which was, and everybody needed dollar at the time. And that was very much at the origin of then the calls for De Gaulle to actually ask for the French-held dollars to be converted into gold and to participate in the run on the Bretton Woods system, which would eventually lead to the collapse of Bretton Woods from 1971 to 1973. And then, as you know, we jumped into the fiat currency system after 1973, where the dollar was not supposed to be anything special any longer, except that it still was very special. And this is what we are going to discuss a little bit later. Now, that was the De Gaulle kind of Giscard d'Estaing view on exorbitant privilege. Now, what is quite striking in terms of historical parallel is if we now look at what Stephen Miran has been writing about the role of the dollar in the international monetary system. And here, he seems to see it a lot more as a burden. So he doesn't talk as a duty, as a privilege coming with a duty. He talks of the America's status as reserve currency as a burden because it comes with an overvalued currency, eroding the competitiveness of the export sector, and this burden has to be balanced against the geopolitical advantages of achieving core national security aims at minimal cost, etc., etc. So this is very much a different style of approach to the role of the dollar, and as a burden versus the kind of privilege view that we had in Europe in the 1960s. Okay, so what did we do a little bit more formally with this view of the exorbitant privilege with Pierre-Olivier Gourinchas, and that goes back to 2007. Actually, that goes back to a book that was edited for the NBER by Richard Clarida, who is on the faculty here, where we computed what we defined as the exorbitant privilege. And how did we define it precisely in economics terms? We defined it as the excess return that the US earns on its external assets compared to its external liabilities. That was our definition. And as you can see, this is really, in a way, the spirit of the De Gaulle thing, because De Gaulle was saying, you refinance at low cost and you buy European companies. So the European companies give you high return and you have low financing costs. So you get an excess return here. And this is the corresponding meaning was the total excess return of US external assets over US external liabilities that we computed. And it turns out that it's not trivial quantitatively, and I will show that to you. And that's therefore not trivial for the long-run sustainability of US external deficits. Okay? If you make extra return on your assets compared to your liabilities, that means that you can run more external trade deficits, and your net external position is not as bad as it would be if you didn't have your excess return. And this excess return on assets compared to liabilities is due to the asymmetry of the external balance sheet of the United States. And the asymmetry comes because your assets are very different from your liabilities. And this is what I will show you in the data. Now, the second bit that I said is characteristics of this balance sheet is the exorbitant duty. So here, that's not the burden of Stephen Mirren. What is the duty? It's something that is really the other side of a coin compared to the exorbitant privilege. If you have risky assets on the asset side of your balance sheets, okay, if you have French companies, or if you have Japanese equity on the asset side of your balance sheet, what happens in crisis times? Well, in crisis times, the valuation of all these risky assets goes down. On the liability side, you refinance cheaply. Why do you refinance cheaply? You refinance cheaply because you have US government bonds, which are sold to foreigners, okay? These are the safe assets. These are the reserves assets. That's the, a reserve currency is by definition a currency that is held in the reserves of central banks. And what are the reserves of central banks? US treasuries, US government bonds, etc. So in bad times, what's happening there? Well, the value of these assets goes up. The value of the dollar goes up. So if you think about it, in crisis time, the value of the assets collapse. The value of the liabilities goes up. So that means assets minus liabilities becomes really very negative. So your net foreign asset position in the US becomes very negative. A negative net foreign asset position means a wealth transfer from the US to the rest of the world. It's a massive wealth transfer at a time where you have a global crisis. So at a time where marginal utility of consumption is very high. This is an insurance transfer. And this is the other side of the coins. In good time, you have an exorbitant privilege, which is essentially the fee that the rest of the world is willing to pay you to insurance, for insurance. And in bad times, you have insurance transfer. So the World Banker balance sheet of the United States acts as an insurance for the rest of the world, essentially. And that's the duty. Okay? So the duty is the other side of the insurance. Now, we are going to model these two facts. And if we model it using that idea of insurance, that means we are going to have a model of international risk sharing. And the US will have to be modeled in a way that it is the country providing the insurance to the rest of the world. And we are going to be looking at the implications of that, in particular when we change a number of structural parameters, and we'll have to see what is needed in order to get these stylized facts that I've just described in an international risk sharing model, and you will see that it's not totally trivial, in fact. All right. So now let me show you the data, the stylized facts that I explained, and then I will go into the model and the estimation of the model and the results that we have. So the external balance sheets, we started so a while ago on this data with Pierre-Olivier, and there the main difficulty was that in order to discuss this issue about excess returns and about duty, obviously you needed market values of all the external assets and liabilities of the US. Okay, it could not be at book value. And in order to get market values at a relatively high frequency, we built the data at quarterly frequencies. You needed to rely on two sources of data. One is the balance of payments. You have the flows, which are at book value. And then you needed the positions. And these are based on surveys, which are at market value, but were very infrequent, especially towards the beginning of the sample after the Second World War. There are very few surveys. And it was quite interesting because when we started to look at that, so the BEA was not producing this data. It's subsequently the BEA produced quarterly data at market value after we kind of started the work. But we realized that there were very infrequent surveys of cross-border positions, but the The best initial surveys that there was were wartime surveys, because at the time we interviewed people at the US Treasury actually about that. They said, yes, of course, in war times, you really wanted to know where the assets were and how much people had, right? So these surveys were realized with a lot of care during the war years, and then they were realized relatively infrequently until the more recent periods where they become a lot more frequent. Now, when you rely on these two sources of data, so unavoidably, if you look at the data construction, you are going to have the positions with infrequent surveys, the flows with the balance of payment at book values, then the valuations that you have to compute. So that means you have to take into account all the different types of assets and the currency in which they are, et cetera, et cetera. And then you're going to have some discrepancy between the years, because you have two data sources, and evidently it's never going to add up fully. So once we kind of deal with that, and we take that into account when we compute excess returns and exorbitant privilege, etc., so we get this type of picture for the US gross asset position. So this is the external assets of the US as a percentage of GDP for the US. You see that if we look at these assets, there are two big lessons that we can draw from this. The first one is that financial globalization really started in the 1990s, okay, because that's where the cross-border positions start to go up massively. And the second position is that there is a lot of heterogeneity in terms of type of assets, but really on the gross asset side, you see that direct investment and portfolio equity, which are the green and the purple, are really big. So indeed, you have a lot of risky investment on the asset side of the US balance sheet. Okay? So that's a big lesson. You also see that we go up towards 120% somehow of US GDP, about that. Okay? Now, if you keep that in your eyes, and I switch to the gross liability position, what you see here is that, first of all, same story in terms of cross-border position growing massively in the 80s, 90s, really. And then you see the colors are somewhat different. Here we have a breakdown between corporate debt and government debt. And you see that these two components, they kind of are much more massive on the liability side than on the asset side. We still have direct investment, and we still have portfolio equity, especially in the recent years. But what is really different is that we have a lot more debt on the liability side, okay, which is this business about issuing the reserve currency that the central banks are holding and being able to refinance at low cost, because you can issue these papers that everybody wants. Okay. So there is a big asymmetry. And this is what makes the US external balance sheet a world banker balance sheet, because it is short safe assets mainly and long risky assets. Okay? So that's like a banker. And the exorbitant privilege is like taking the banker's fee. Except that when you look at the net foreign asset position, which is just assets minus liabilities, you can see that that banker has been losing a lot of equity in the sense that you see that the net foreign asset position has really deteriorated quite massively over time. And there is a second very noteworthy phenomenon, is that you see that for most of the time, the dark line, which is my assets minus liabilities at market value, was well above the red line, which is the cumulated current account over GDP. So the cumulated current account is simply, you're essentially mostly the trade deficit of the US that accumulates over time, and without taking into account market valuations, while the other stuff takes into account market valuation. So for a long time, the kind of dark line is well above, and this is because of the exorbitant privilege. This is exactly what it was. You had an excess return, so you were well above what would have been predicted by your trade deficits. But look at that. It's not the case anymore in the recent years. And the recent years, you see that we have lost the exorbitant privilege somehow. It's below, essentially. So what happened in the recent years? Well, in the recent years, we had the US, so-called US exceptionalism in the markets, which is the strong outperformance of US equity market and a lot of foreigners buying portfolio equity in the US. And so that means that you have a lot of US liabilities, more than historically, that have been US equity, and these equities have been very strong in terms of valuations. And so that has changed the picture somehow. Now, whether it is a permanent thing or a cyclical thing, we don't know. But certainly, this is a new phenomenon. All right, so what is still true, however, is this very strong safe liability side of the United States. So here, this is another split of the data. It's within asset categories. For example, within equity, it's equity assets minus equity liability. That's what I call net equity. And same thing within FDI, within debt. So it's debt assets minus debt liability, etc. And you see that it used to be that if you look at the dark line on net equity, it was well above zero. And in particular, you can see that before 2008, we had a strong net equity position here. And then you see the US exceptionalism. So you see the outperformance of the US equity market. At the very end of the sample, you see that it goes down. And same thing for the FDI. Same thing actually for the banks also, which is the bank loans. But what has remained extremely noticeable and important is that the net debt is eminently negative. Okay, and that just shows the fact that simply there's a lot of US debt which is held by the rest of the world because it's a safe asset. And because it's a big part of a lot of foreign investors' balance sheet. Right? So this is still very much there. So there's still a lot of, you can think of it, of a lot of leverage here. So it's a very asymmetric external balance sheet. It's a leverage position. And there has been some interesting movements in the last part of the sample about the liability side of the US, but there's still a very dominant safe liability side in net terms for the US. Now, if we compute the exorbitant privilege until 2000, so here it's until 2016, so you see that depending on the assumptions you are willing to make with the error terms in the statistical formula I gave you before, you're going to find an exorbitant privilege for the whole sample, 1950 to 2016, of about 2.7% or 1.5%, roughly like that. If you do the mixed thing around, let's say, around 2%. So in real term, the exorbitant privilege during that period was about 2% real term. Every year, right? It's a yearly excess return. So it was not trivial. And this is during the entire period where you have seen the blue line that was above the red line. And the recent period has wiped this out, okay, essentially. It's very important to look at long periods, obviously, when you look at that. But the recent period has been different. And there's a paper by Andy Atkinson and co-authors who is essentially about that. And trying to find out why the US equity market essentially outperformed so much, and talking about markups and things like that. But is it permanent or not? I think nobody knows at this stage. But it is clear that if you look at the exorbitant privilege over time, and here you have a kind of moving average, okay, you can see that there is a secular decline in the exorbitant privilege, which is what we also figured out by just looking at the data. But here you can see it. It's very clear. There is a decline in exorbitant privilege defined as the excess return on assets, external assets minus return on external liabilities. It also maps, by the way, on a more narrower thing, which is what people have looked at in the literature on convenience yield. And you have a bunch of papers who argue that the convenience yield of US bonds, on US treasuries, has been trending down. Okay? So this is within a much narrower type of assets, that literature. It defines convenience yield, in some ways. and it finds that it has been trending down. And here, in the more kind of general exorbitant privilege thing, we kind of see the same thing. Right, so how about this exorbitant duty business? So how does that play out? Well, you can see how it plays out. Again, by looking at this graph, if you look at the global crisis period here, we had one massive, and that was in 2008. That was the Lehman Brothers shock. And you can see the 2008 This is a bit like a cliff here. This is a cliff because in 2008, so we have this very leveraged balance sheet where you have all these US treasuries on the liability side, and you have these equities, portfolio equity and FDI on the asset side, and you see a massive decline in the value of these risky assets, right? Every single risky asset in 2008 went down like crazily. So that means this is a massive deterioration of the US net foreign asset position, which is a massive wealth transfer, about 14% of GDP transfer from the US to the rest of the world. Then you see some more after that. So after that, you have the euro area crisis, which is another cliff. Then you have some periods which, I wouldn't associate with a global crisis, but you had massive dollar appreciation following asymmetries in monetary policies between, in particular, the euro area and the US. But then you had also, more recently, we have also the COVID shock and then the Ukraine war. So it looks a bit like in the recent periods we have been hit by quite a succession of crises, and during each crisis, we had this negative effect on the US net foreign asset position. So from a cyclical point of view, it seems that this has also contributed to the deterioration of the US net foreign asset position. And let me just point out that it is certainly true that we have these transfers or this net effect on the NFA during global crisis time, but it's a more general proposition, obviously, because if you look at the valuations effects on the net foreign asset position of the US, which is in blue, and the VIX, which is an index of stress, a gauge of fear, usually we say in international finance, you see that there is a very clear negative co-movement. So even for smaller shocks, when you have smaller stress on international markets, you have also these negative effects on the NFA. It comes from this asymmetry of composition between assets and liabilities, so it's fairly clear. But we have been hit by quite a few shocks recently. So these few shocks means the US has performed its exorbitant duty, which is this transfer of wealth from the US to the rest of the world, which is implemented simply because of the asymmetry in the portfolio of the US as a country. So this is the insurance payment, while, again, the privilege corresponds to the insurance premium. Okay, and this is very much this interpretation that now I'm going to be briefly describing to you how we model that and some kind of what are the ingredients that are actually needed to make this point in the simplest model we could think about, and how then by tweaking this model one could possibly think about changes in structure. So this has to be, if we are willing to go with this World Banker idea and this insurance mechanism, it has to be a model of international risk sharing. And I'm just going to give you the main intuition, essentially, behind the model in a very, very simple case, where you can just think of the world as two countries, the US and the rest of the world, and just an endowment economy where you have some traded good here, some households who is risk averse, but the only kind of important assumption is going to be that the US is less risk averse than the rest of the world. So I'm going to be modeling the US household as being less risk averse than the rest of the world. Now, what does it mean? It could mean that actually the domestic financial markets in the US are better at sharing the risk. And so if this is the case, there are some papers that show that a micro foundation, essentially of this asymmetry in risk aversion, can come from having more incomplete markets in one country than the others, and the more incomplete market country will show up as more risk averse than the country in which the financial markets are more developed. Or you could think of it as there's a cultural difference here between the US and the rest of the world, and the US is more risk-taking. But whatever you think, if you have an asymmetry in risk aversion, that will mean that in bad time, the more risk-tolerant country, that is to say the US, will insure the rest of the world. And so this is why it's kind of a key building block in this interpretation of the international monetary system. So we are going to think here everything in complete markets, not because internationally, not because we think it's realistic, but because this is a kind of minimal setup in which we can make our points. So how does the international risk sharing works when you have asymmetric risk aversion? Well, so if you take this two-country world here, and you have here the realization of global output is on the horizontal axis. If you are in a small, on the left here, that is a small realization of global output, so these are bad times, and the US is the dark line. In bad times, if you are more risk tolerant, you are insuring the other guy with the dashed line, the rest of the world, and so you are shipping goods essentially from the US to the rest of the world in bad times. But in good times, where global output is high, so close to 2 here, this is exactly the opposite. So this is here a very basic insurance mechanism that is set up in complete markets. That's what a planner would want to do. It would want to give more consumption to the more risk-averse country in bad times, and to give more consumption to the more risk-loving country in good times. And this is exactly what this graph is just illustrating. Okay? So this is a very, very basic way of getting this international risk-sharing mechanism that we argue is a characteristic of the data that we just looked at. Now, if we had only this in our model, so we would have the international risk-sharing mechanism, but there's lots of things we could not talk about. In particular, this business about the dollar appreciating in bad times, which is pretty key in international data. We couldn't have it because here in a traded good, we wouldn't have a real exchange rate. So with one traded good, so that would not work. So we need to introduce more goods, and we will introduce a traded and a non-traded good. And we want to be able to talk about the size of the country at the center of the international monetary system. So we need to introduce a parameter for size of countries to look at asymmetric size. And we also want to talk about not only business cycle risk, like I've shown you with my global output, which could be high or low, but we would also like to talk about global crisis times, okay? Because Lehman Brothers and the euro area crisis, etc., they were pretty big shocks. So we also want to have that. So this is what we do. And you will see that another key assumptions that we are going to be introducing, but that will be quite an important one, is that we will allow for state-dependent degree of risk aversion. So what is that? Well, we are going to be allowing for the fact that when we are in a catastrophic time, or we'll have also fragile time here, we'll have three different states, normal, fragile, and catastrophic. Well, if you go from normal to fragile or to catastrophic times, your degree of risk aversion might increase. So people will be a lot more nervous. And why are we doing that? You will see that, well, actually, too much of the data, it's going to be fairly key. But also, because in some other work that I've been doing, the global financial cycle is pretty much a key characteristics of the data, and the interpretation of the global financial cycle that I've been favoring is one of time-varying degree of risk aversion in the markets, something that people usually refer to as risk-on and risk-off in the markets, and that's very important for the pricing of international financial assets, of assets in general. and international transmission of monetary policy also as well. So here we are going to be introducing a global financial cycle, risk on, risk off, in the model by having time-varying degree of risk aversion. In fact, it's dependent on the state of the economy. If the economy becomes more fragile, people become more risk-averse. Okay? And that's going to be actually, the model is going to tell us it's actually important in the data. Okay, so I won't give you all the technical details here, but for those of you who are interested, everything is in the paper, so I'm just going to give you the building blocks, and we'll leave you without a lot of the derivations. But we have these two countries, and they have, each of them have a non-traded good, plus there is a globally traded good, okay, and each of the country has endowment in these traded goods. The size of each economy is parameterized by the parameter alpha, and we keep the key assumptions that is underlying everything, which is somehow that at some point we have the rest of the world which is going to be more risk-averse than the US. Okay, so that's going to be really something quite key. And then we have some consumption preferences, which you can see here as CS preferences, and the resource constraints are very simple for the non-traded good. And then we have the resource constraints for the globally traded good with the size of the country entering. And we have complete markets to make the model simple. So the way we are solving it is by looking at the planner's allocation and solving a standard planning problem here. So I won't go into detail, but because this is an endowment economy, you can solve state by state, and you are it's going to be relatively transparent what we do, and you can derive all the key variables we want to derive relatively easily, state by state, in this setup. So we have some usual risk-sharing conditions here, which are a little bit more involved than usual because we allow for non-separability between non-traded and traded goods, but otherwise, if you had separability, the red stuff would be zero, and you would have a standard market risk-sharing condition for the traded good here. All right, so in that setup, we define the planner's allocation. We can solve for the domestic, the price of a domestic non-traded good, which is very tightly linked to the real exchange rate. That's QT, and depends inversely on the, depends actually, inversely on the non-traded good endowment, but depends in a positive way on the consumption of traded good, okay? And then you have a common stochastic discount factor since markets are complete. So I leave you, on the detail here. However, the only thing I want to give you as an intuition here is that if we think about the risk sharing now, which is the heart of the model, we have to think about which assets are good hedge or not good hedge in the context of the various shocks in our model. And the various shocks are shocks to the non-traded good, shocks to the consumption of traded goods, and whether an asset is going to be a good hedge or not will depend actually on the co-movements between the stochastic discount factor and the real exchange rate in this model. So it's important to keep track whether the shocks on non-traded goods will appreciate the real exchange rate or depreciate the real exchange rate, etc. So this is why here I explained to you how things work. You can find all of that by looking at the first order conditions, but I don't have time to go through it. But this is essentially what you find. Now, what is interesting is that you see that the consumption of traded good in particular doesn't move in the same direction if you have a shock to the US non-traded good or a shock to the global traded good. And same thing for the rest of the world. So things are not totally trivial when we think about the shocks that are hitting the economy. So we are going to be tying our hands pretty hard here because we are going to calibrate the business cycle shocks in a very conventional way. And we are going to say that the catastrophic shock that are going to hit our world economy are essentially similar across all sectors. So we are not going to be having an asymmetric shock hitting the US or hitting the rest of the world. We are really truly going to have a catastrophic shock hitting the global economy. And so that means that essentially the hedging properties of the models are not trivial ex ante, and it's really the quantification that will tell us which assets are good hedge and which assets are not good hedge. Okay, so I will pass on the characterization of the various consumption allocations, which we can solve for. And on the asset pricing, I will just say that in a setup like that, the beauty is that you can solve for any asset price in a very general manner. And because you have any asset price in the economy, you can also solve very, very generically for the wealth of each country. So again, this is all technical things, so I'm not spending any time, but the formulas, for those of you who are into this literature, are nice to see. For the others, just bear with me a second, because then we will go to the results of the model. You can express the wealth of each country using the country's budget constraints under complete markets. So this is a formula at the bottom. And you can also price the endowments of each country. This is the V's. You can price the Lucas trees also in a very nice way. So here you have the endowment of traded good, the endowment of non-traded good, the relative price Q between traded and untraded good, the M's are the stochastic discount factors, the V are the values of the Lucas trees. And without knowing more, the beauty of this setup is that you can find also the value of the net foreign asset positions, because it's just the wealth of the country minus the value of its endowments. So you can see that very generically, you can express the net foreign asset position of the US and the rest of the world by just inverting some matrix here of stochastic discount factor. I is a matrix of identity. This is formula number 3 there. And you can see that the net foreign investment position of a country is the value of a claim to current and future trade deficits, as it should be, okay, in that economy. So that's very generic, pretty for the people who like this type of things. And that tells us that we can essentially solve for this whole entire thing very easily. Okay, so now, what are the shocks we put? So we have effectively 3 types of shocks, essentially. Well, we have a shock on the non-traded goods of each country. We have a shock to the traded good, and then we have this catastrophic shock. Okay, so this is the stochastic structure of our model. And we have these 3 types of states of the economy. One is a normal business as usual state in which, there's a business cycle shock and there's a low probability of having a terrible shock happening. Then there is a fragile state in which there is a higher probability that something bad is going to happen. Okay? And then there is a catastrophic state in which there is a big catastrophic shock happening. And the catastrophic shock happens to everyone, every sector in that world economy. We use Barrow's style of modeling for the catastrophic shock. Here, the catastrophic shocks are the little news towards the end of the shocks, and the business cycles are the little epsilon. And when there is a catastrophic shock, we have a pretty bad fall of output. Okay? And how much it falls is parameterized by this parameter B here. So that's the stochastic structure of the model. We also allow for, in bad states of the world, in catastrophic states of the world, for the recovery rate on the safe foreign asset to be less than safe, so for a haircut. Okay, so here, because we have now these ingredients, we can effectively parameterize the catastrophic shocks of the world by varying this parameter B, we change the skewness of the output. We can look at an effect of risk on, risk off. So in fragile state, we allow for the risk aversions to go up. Okay, you see that things are looking pretty nasty. You become, the VIX starts to go up. So that's sigma going up. and it can go up differentially at home in the US and in the rest of the world. And that's pretty much one of the key thing in our model. So we, as we said, it's very key to be able to allow for these coefficients of risk aversion, which are moving, but also which are asymmetric between the US and the rest of the world. Now, obviously, what happens when the world becomes fragile? The rest of the world wants more insurance. Okay? And that's going to trigger more demand for insurance, which is given by the US, which is the most risk tolerant. And that's going to be the key thing to generate in that type of model the real appreciation of the dollar. Okay? So that's really the important mechanism here. So we are going to be estimating this model. So we have some calibrated parameters, and I will spare you the detail. It's mostly taken from the literature, in particular the papers of Barrow and various papers of Barrow. And then we are going to be matching 13 moments. And the moments we're going to be matching are exorbitant privilege, exorbitant duty, appreciation of a real exchange rate, and then trade balance, net foreign asset position, etc. And we are calibrating this model or matching these moments on the episodes which include the global financial crisis. But for us, the euro area, etc., after that is out of sample. Okay? So that's the type of periods in which we are computing these moments. And we are estimating the model using the simulated method of moments. And here is what so we managed to essentially match everything quite closely, except the exorbitant privilege, we are below it. So if you look at each of these moments here that we are matching, you're going to see that the estimates and the target columns are very close, except the exorbitant privilege, we are below. Okay, we are not matching our target. We are below it. But for the rest, we do a good job, as they say in that literature. But what is very interesting is that these models and the methods we used, in particular, there's a couple of papers by Andrews, Jensko, and Shapiro who are really good there to let us know where is the information coming from to find the various parameters we estimate, and whether the estimates that we have are sensitive to certain moments or not. So we kind of know exactly what is important to get the data right, and we also know whether the moments we match, they are very sensitive to some types of parameters that we have. We can look at these things. And the very interesting bit, I think, is that in order to match the data, we do need action on risk aversion. But the action on risk aversion and the asymmetry on risk aversion, the important one, is in the fragile or disaster state. We can match the moment very well by having a similar risk aversion at home and foreign, the two first lines, which a very similar coefficient. Here we constrain them to be the same, but we could let them vary, but they wouldn't be very dissimilar. What is really important to match the data is to have an increase in risk aversion in fragile and disaster time, which is asymmetric between the US and the rest of the world. We need the rest of the world to become a lot more risk averse in a fragile and disaster time, to have an increase in risk aversion of 4.8%. This is the fourth line, whereas the US becomes more risk averse, 0.84, but not that much more. That's really the key thing for in the parameters that we estimate to be able to match the data. The rest is less key. Though, okay, we find also some other parameter estimates here, but it's really this thing that enables us to match the data. So our model allows us to replicate the exorbitant privilege, even though we don't get the full amount. So that means, we are probably missing some liquidity stuff here, which is absolutely not in the model. Okay, so there's probably other characteristics of the US beyond the risk-sharing characteristics, which would be relevant for the exorbitant privilege that we are not capturing. But the rest, the duty, the trade balance, the appreciation of the dollar, we can get here pretty much, and all the other moments we can get. The thing that is absolutely key is the asymmetric increase in risk aversion in fragile and disaster time, and a much bigger increase for the rest of the world than for the US. This is what is really key in that model to match the data. So in a way, the way I interpret it is the global financial cycle is very important, and it's important in a world where asymmetric risk-taking is pretty key. So this insurance thing plays out, but it plays out really a lot in stress time. Okay, so I'm going to finish. I'm aware of going out of time here, I guess, by saying that because we now have estimated the model and we have the coefficients, we could do a bunch of exercise. So in particular, what happens when you let alpha, the size of the US economy, go down, okay? So the size of a hegemon go down relative to the size of a world economy. And you get a bunch of relatively intuitive but interesting results. The first one is that in fragile time, you will get a much bigger change in the NFA position. So it's like your duty kind of goes up as a fraction of your GDP quite a bit. The second thing is that real appreciation becomes higher also in bad times, in fragile times. So it's more exchange rate, more volatility in the exchange rate. The real interest rate goes down, and this is because the size of the hegemon goes down. There's a lot of insurance, so this pushes the price of a safe asset up, so the real rate going down. And we have graph to illustrate that, so I won't go through that, but this is how the real rate changes with the relative size of the hegemon, how the size of the duty goes up as the size of the hegemon. So we'll just conclude in saying that I think at least this is a credible way of how the international monetary system works in terms of interpreting the role of the dollar as a reserve currency, that is to say, as providing insurance to the rest of the world. It doesn't cover all the aspects of the international monetary system, but I think it covers an important one that kind of is able to account for the shape of the balance sheet of the US, the excess returns, so the privilege, the duty, etc. And you can see that we've played with the size of the hegemon, okay? Now, interestingly, the size of the US in the world economy had gone down for quite a while, but now has gone back up a bit. Okay, so it was if you looked at the 1950s, it was, it was above 50% in terms of GDP, then it went down to 18%, and now it's back to 25%. Okay, so this is, so the alpha has had this kind of non-monotonic path, and recently going back up. Now it would, so that's the comparative statistics we have done, which has implication for the real rates and the real exchange rate. You could also think of other comparative statistics, like, playing on the willingness of the US to insure, right, for example. So introducing some friction there in the way the insurance mechanism work and see how that plays out. So there's a lot of things that we could use these kind of models to interpret some shocks that we might be seeing in the geopolitical environment. And hoping I haven't lost you completely, let me stop here.